Section 2:1 Understanding the Volatility Index, VIX, Interpreting the VIX, 2.1 Relationship with Market Volatility. The relationship between the VIX and actual market volatility is complex and dynamic. While the VIX is designed to measure the market's expectation of future volatility, it does not directly track or predict the actual realized volatility of the market. However, there is often a relationship between the VIX and actual market volatility, though it can vary. General inverse relationship. In general, the VIX tends to have an inverse relationship with actual market volatility. When the VIX is high, it suggests that market participants expect increased volatility and potential market downturns. Conversely, when the VIX is low, it indicates that market participants anticipate lower volatility and a relatively stable market environment. Forward-looking expectations. The VIX reflects market participants' expectations of future volatility over the next 30 days. It is important to note that these expectations are based on current market conditions, investor sentiment, and other factors. However, actual market volatility can deviate from these expectations due to unforeseen events, economic data releases, geopolitical developments, or other factors that may impact market sentiment and volatility. Market reactions. Significant market events or news can trigger sharp movements in both the VIX and actual market volatility. For example, unexpected economic data, political turmoil, or corporate earnings surprises can lead to increased market volatility, causing the VIX to spike. Similarly, positive news or market stability can result in decreased volatility and a decline in the VIX. Time horizon. The VIX specifically measures implied volatility over a 30-day period. As the expiration date of options included in the VIX calculation approaches, the VIX may become more sensitive to changes in actual market volatility. Mean reversion. Historically, the VIX has displayed mean reverting behavior. Extreme readings of the VIX, whether high or low, have tended to revert back towards the long-term average over time. This means that periods of high volatility are often followed by periods of lower volatility and vice versa. It's important to recognize that the VIX is just one tool among many that investors and traders use to assess market volatility. While it provides valuable insights into market expectations, it should be used in conjunction with other indicators, analysis tools, and fundamental research to form a comprehensive view of market conditions and make informed investment decisions. Changes in the VIX can indeed provide indications of shifts in market sentiment and risk appetite. The VIX is often referred to as the fear gauge of the financial markets because it reflects market participants' expectations of future volatility. Here's how changes in the VIX can signal shifts in market sentiment and risk appetite. Market uncertainty. When the VIX experiences a significant increase, it suggests that market participants are becoming more uncertain about the future direction of the market. Higher VIX levels can indicate increased fear and concern among investors, reflecting a shift towards risk aversion. This can be driven by various factors such as geopolitical events, economic uncertainties, or negative news. Market complacency. Conversely, when the VIX experiences a sharp decrease, it can suggest a higher level of market complacency and lower perceived risk. This often reflects a shift towards risk appetite, with investors becoming more optimistic and willing to take on higher levels of risk. Lower VIX levels can indicate a sense of stability and confidence in the market. Risk-on versus risk-off sentiment. Changes in the VIX can provide insights into the overall sentiment in the market, with higher VIX levels signaling a risk-off sentiment and lower VIX levels signaling a risk-on sentiment. During periods of heightened volatility and increased VIX levels, investors tend to be more risk-averse, seeking safer assets and reducing exposure to riskier investments. Conversely, during periods of lower volatility and decreased VIX levels, investors may be more willing to take on risk and invest in riskier assets. Flight to safety. When the VIX spikes and market sentiment turns negative, there is often a flight to safety. Investors may seek refuge in assets considered less risky, such as government bonds, gold, or defensive stocks. This flight to safety can be indicated by higher demand for these assets and a decline in riskier assets. Sentiment extremes. Extreme readings in the VIX, whether high or low, can indicate sentiment extremes in the market. Extremely high VIX levels may suggest excessive fear and panic, potentially signaling an oversold market and a potential buying opportunity. On the other hand, extremely low VIX levels can indicate excessive complacency and euphoria, potentially signaling an overbought market and a heightened risk of a market correction. It's important to interpret changes in the VIX in conjunction with other market indicators, economic data, and news events to gain a comprehensive understanding of market sentiment. The VIX serves as a valuable tool for assessing shifts in market sentiment and risk appetite, but it should be used in conjunction with other analysis tools to make well-informed investment decisions.